If you left £10,000 in a regular savings account for the last 10 years, inflation alone would have quietly destroyed a huge chunk of its real value, even though the number on the screen never went down. Problem: believing that saving money in a bank account is the same as growing your wealth. Why it matters: inflation, the gradual rise in prices over time, quietly erodes the purchasing power of cash sitting still. Investing means putting your money into assets like stocks, bonds, or funds that have historically grown faster than inflation over the long term. Real example: £10,000 sitting in a low-interest savings account for 10 years might barely keep pace with inflation, meaning it buys roughly the same amount of stuff a decade later. The same £10,000 invested in a diversified fund averaging 7 to 8% a year could roughly double or more in that same period. Step-by-step solution. 1. Understand the difference. Saving is for short-term goals and emergencies. Investing is for long-term growth. 2. Keep 3 to 6 months of expenses in savings first. We'll cover this more in part 2. 3. Everything beyond that emergency cushion is a candidate for investing, not just saving. Common mistake: treating all extra money the same way, whether it's needed next month or not needed for 10 years. Problem: jumping straight into investing without any financial safety net or without clearing high-interest debt. Why it matters: investing is a long-term game. If an emergency forces you to sell investments early, possibly during a downturn, you can lock in real losses on money that would have otherwise recovered and grown. Real example: someone who invested everything and then had an unexpected job loss was forced to sell shares during a temporary dip just to cover rent, turning a paper loss into a permanent one. Step-by-step solution. 1. Pay off any high-interest debt, roughly above 8 to 10% APR, before investing seriously. 2. Build an emergency fund of at least £500 to £1,000 to start. 3. Once both of those are in place, you're ready to invest with real peace of mind. Common mistake: investing first and figuring out the emergency fund later. It should come first. Problem: not knowing where to actually put your investment money, or investing through the wrong type of account and missing free tax benefits. Why it matters: in the UK, a stocks and shares ISA lets your investments grow completely free of capital gains and dividend tax, up to £20,000 a year. Ignoring this means potentially giving away money to tax that you didn't need to. Real example: £1,000 grown to £5,000 outside an ISA could trigger capital gains tax on the £4,000 profit. Inside an ISA, that same profit is entirely tax-free. Step-by-step solution. 1. Open a stocks and shares ISA with a reputable, low-cost provider. 2. Compare platform fees. Look for low, flat, or percentage-based fees, ideally under 0.25%. 3. If you're outside the UK, research your own country's tax-advantaged investment account. Common mistake: assuming a regular investment account is fine because it's simpler to open, without realizing the tax cost over time. Problem: either avoiding investing entirely out of fear of risk, or taking on far too much risk by putting everything into one stock or trend. Why it matters: all investing carries some risk, but diversification, spreading your money across many different companies, sectors, and regions, significantly reduces risk. Real example: an investor holding a single stock can lose 50 to 90% of their investment if that one company struggles. An investor holding a diversified index fund is protected. Step-by-step solution. 1. Start with a broad, low-cost index fund that spreads your money across many companies automatically. 2. Understand your own risk tolerance. 3. Adjust your mix of stocks versus bonds based on how soon you'll need the money. Common mistake: confusing no risk with smart. Problem: believing you need a large sum of money to start investing properly. Why it matters: time in the market matters more than the amount you start with. Real example: someone investing a small, consistent amount automatically every month from age 22 will typically end up ahead of someone who waits until 32 to start. Step-by-step solution. 1. Start with whatever amount is genuinely comfortable, even if it's £25 to £50 a month. 2. Set up an automatic transfer. 3. Increase the amount gradually as your income grows. Common mistake: waiting to save up enough before starting, which delays the most valuable ingredient, time. Problem: checking your portfolio constantly and reacting emotionally to every market dip or spike. Why it matters: markets naturally go up and down in the short term. Real example: investors who panic sold during the 2020 market crash locked in losses of 30% plus, while those who stayed invested saw the market fully recover. Step-by-step solution. 1. Check your portfolio quarterly at most, not daily. 2. Remind yourself of your long-term goal whenever a downturn feels scary. 3. Review and rebalance your investments once a year, not in reaction to news headlines. Common mistake: treating short-term market noise as a signal. Here's your exact beginner roadmap in order. 1. Understand why investing matters. Inflation makes doing nothing costly too. 2. Build your foundation. Clear high-interest debt and set aside an emergency fund. 3. Open a tax-efficient account like a stocks and shares ISA. 4. Start with a diversified, low-cost index fund rather than picking individual stocks. 5. Automate small, consistent contributions and increase them over time. 6. Leave it alone and review your plan once a year, not once a day. Investing isn't about being an expert from day one. It's about understanding the basics well enough to start and letting time and consistency do the heavy lifting. If this helped, subscribe for more real talk money breakdowns and tell me in the comments which part of investing has confused you the most.